$5,000. That's all you borrowed. Pay it back the way your bank quietly suggests, and you will hand over $13,886 before it's gone. Nobody tells you that on the day you sign. Compound interest is the force that builds fortunes. Warren Buffett calls it the eighth wonder of the world. But flip it around, point it at debt instead of savings, and it becomes the exact opposite. It stops working for you. It starts working against you silently every single month, while your statement tells you you're making progress. Let's start with the credit card, because this is where most people get quietly wrecked. $5,000 at 24% interest. You do what the statement recommends. You pay the minimum. That minimum shrinks a little every month because it's calculated as a percentage of a shrinking balance. It feels responsible. It feels like paying your bills. Here's what's actually happening underneath. 19.5 years. That's how long it takes to erase that $5,000 if you only ever pay the minimum. 19.5 years and $8,886 in interest alone. You will pay almost triple what you borrowed. And for the first several years, most of every payment you make doesn't touch the principal at all. It just covers the interest that piled up since your last payment. You're not climbing out. You're treading water while the bank charges you rent for standing still. But that's not the one that does the most damage. That one's just the fastest. Now picture the mortgage, because this is the loan most of us will carry for most of our adult lives. $300,000, 30 years, 7% interest. The monthly payment comes out to $1,995. Multiply that across 360 months, and the total comes to $718,526. You borrowed $300,000, you will pay back $718,000. That's $418,000 in interest, on top of the house itself. You are paying for 2 houses to live in one. Here's the part your amortization schedule never explains out loud. On your very first payment, 87.7% of what you send is pure interest, not equity, not ownership. Interest, and it doesn't get better quickly. It takes 20.2 years into a 30-year loan before the principal portion of your payment finally overtakes the interest portion. For 2 decades, you are primarily a renter who happens to be paying the bank instead of a landlord, while calling yourself a homeowner. That's the design. Amortization is front-loaded on purpose. The bank collects its interest early and fast, while your risk is highest and your balance is largest, and it lets your equity build slowly, in the back half of the loan, once the balance and the bank's exposure has already shrunk. Now here's where it gets worse, and where almost no one is paying attention. Student loans, $30,000, 10 years, 6.5%. Pay it on schedule, and you'll send back $40,877. $10,877 in interest. Manageable, on paper. But most people don't pay it on schedule. Most people defer. Here's the number that should scare you more than any of the others. Defer that same $30,000 loan for 3 years, no payments, while interest keeps accruing and capitalizing onto the balance every month. And by the time you make your first payment, you don't owe $30,000 anymore. You owe $36,440. You did nothing. You made no purchases. You borrowed no additional money. Compound interest simply multiplied itself onto itself 3 years in a row while you weren't looking, and handed you a $6,000 bill for the privilege of being given room to breathe. This is the mechanism nobody explains in plain language, so let's say it plainly. Interest doesn't just charge you for the money you borrowed. It charges you interest on the interest you haven't paid yet. Every missed payment, every deferment, every minimum payment that barely covers the interest becomes new principal, and that new principal starts generating its own interest the very next month. It compounds. That's not a metaphor. That's the literal math sitting inside every single one of these 3 loans. And here is the moment that changes everything if you actually absorb it. The math that traps you is the exact same math that can set you free. It's not good or evil, it's neutral. It just compounds in whatever direction you point it. Go back to that credit card. Instead of the minimum payment, send $150 a month, every month, no more, no less. That same $5,000 balance, at the same 24% interest, is gone in 4 years and 8 months. Not 19.5 years. 4 years and 8 months. Total interest drops from $8,886 to $3,322. You cut what you owe by nearly 2/3, and you cut 14 years off your life of paying it by changing one number on one form. That's the whole secret, and it was never actually hidden. It was just never explained. The bank isn't lying to you when it prints the minimum payment on your statement. It's just never going to be the one to tell you that following it is the most expensive decision available to you. The same lever exists on the mortgage, and this is the one almost nobody pulls. Take that $300,000 loan, keep the required payment exactly as it is, and add $200 a month on top, marked specifically for principal. Nothing else changes. Same rate, same bank, same house. The 30-year payoff collapses to 22 years and 11 months. Total interest falls from $418,524 to $301,885. $116,638 gone. 7 years of payments gone. $200 a month, the price of a phone bill and a few dinners out, erases 7 years of your life and buys back 6 figures. Because every extra dollar you send early is a dollar that never gets the chance to generate a decade of compounding interest against you. And the student loan fix is even smaller than that. Remember the $30,000 balance that ballooned to $36,440 after 3 years of silent deferment? All it would have taken to stop, that was paying the interest as it accrued, roughly $162 a month, $5,850 total across those 3 years. The balance never moves. It stays at $30,000, exactly where you started. Compare that $5,800, paid on purpose, on a schedule you chose, versus $6,440 paid by accident, on a schedule the loan servicer chose for you. Same interest rate, same 3 years. The only difference is who was paying attention. So here's what I want you to actually take from this. Compound interest doesn't care whose side it's on. It has no opinion about you. It just repeats whatever instruction you give it, over and over, faster and faster, until small choices become enormous ones. A $5,000 balance becomes $14,000 in fees for patients you didn't know you were paying for. A $300,000 house becomes a $718,000 obligation, 87 cents of every early dollar disappearing into interest before you've owned a single brick. A $30,000 loan grows by $6,000 while you were told you were being given a break. None of this is random, and none of it is punishment. It's arithmetic, running exactly as designed, on a schedule you were never shown. The only real question left is whether you keep letting it run on autopilot or whether you finally read your own amortization table. Find the line where your money stops feeding interest and starts feeding your own future, and point the most powerful force in finance back at yourself, where it was supposed to be working for you all along.